With all the craziness that we've been seeing in the market, especially as of recently in 2025, it seems like a better time more than ever to make a video talking about some of the safest, quote unquote, higher yielding ETFs that I personally think are great investment vehicles to withstand multiple different market conditions, such as even some of the volatility that we've seen as of recent that I'm showing you right here on the screen. Now, with all the volatility, it's also always a good time to look through your portfolio and ask yourself, are certain positions maybe a little bit too risky or maybe not risky enough? And just to sort of rethink everything, which I personally still do, even after almost a decade of investing. But in this video, I'm going to make it very simple for you guys, and we're going to go over 5 different ETFs that all yield somewhere of around 10+% and offer an investor a boatload of income from day one. But the best part of all is that every single one of these ETFs is relatively safe, and that's because of one specific reason. So if you're interested in a higher yield but want safety as well, make sure to stick around, drop a like down below, and let's get right into it. My A to Z dividend investing ebook has helped countless dividend investors get started with their journey. And my custom dividend tracker that I'm constantly using here on the channel has also helped so many investors stay on track and allow them to see their dividend income in real time. Well, today I have another treat for you guys. I'm not only going to offer you my A to Z dividend investing ebook and the custom dividend tracker, but also just for a short limited time, I'm going to be adding in my brand new weekly dividend blueprint ebook to show you how you can get started with weekly dividend ETFs and add this into your investing strategy. This offer is not going to last long, so go ahead and click the first link down below in my description, and you're going to get both ebooks and the custom dividend tracker bundle. But like I said, please act fast because this won't be around for long. Now let's get back into the video. Now, the reason I consider all the ETFs that we're talking about in today's video a bit safer than something like TSLY, for example, Tesla or the YieldMax Tesla Option Income Strategy ETF, which yields around 75%, but that's been decaying like a rock falling out of the sky. This ETF has one single stock as an underlying, that's Tesla stock. So it really depends on how Tesla does on any given day, week, month, or etc. And that's going to give you more or less how TSLY is going to perform. Now, every single ETF in this video is going to be index-based. We're talking S&P 500 or Nasdaq, which means there are tons of underlying stocks that all have to do pretty crummy over a long time period, which doesn't necessarily normally happen, which is why I think all the ETFs we're going to be talking about are relatively safe. Now, the first ETF that yields around 12%, pays monthly, and is relatively safe, generally speaking, because of the underlying, or the S&P 500 that is SPYI or the NEOS S&P 500 High Income ETF. Now, this ETF is not necessarily safe from a crash just because it does have the S&P 500 as underlying, but again, generally speaking, the S&P 500 has always been a great performer and has always recovered over time. Now, this ETF distributes high monthly income from investing in the constituents of the S&P 500 index and implementing a data-driven call option strategy. This ETF does yield around 12%, so you're going to be getting a boatload of cash flow from day one, and even some upside because of this ETF's underlying strategy, all while doing so very tax efficiently. Now, the distributions for SPYI are around a steady 51 cents per share per month, which means for every single share that you buy at around $50 per share, you're getting a few quarters in your brokerage account more or less for certain that following month. Now, as far as performance goes, SPYI is up around 40% more or less on the max time frame. That's total return, dividends, and price return included. This ETF has held up pretty well during the most recent volatility, and I think it's going to do just fine, more or less, of course, unless we see a massive crash, and this is because the S&P 500 is underlying, and the S&P 500 is very solid. Now, the next name doesn't necessarily have the S&P 500 or Nasdaq as an underlying, but it's pretty close to the S&P 500, and that's JEPI or the JPMorgan Equity Premium Income ETF, an ETF that I've held hundreds of shares of my portfolio for several years now. Now, I know JEPI is not the best highest yielding ETF in the entire world. It yields around 7, 8, 9%, depending on whatever time frame you're looking at, but JEPI does have a well-diversified underlying, which is going to be generally safe, or at least it has historically, and this ETF is going to pay you around 35 cents more or less per share per month, depending on the month. Now, also on the max time frame since inception, JEPI is up around 75% if we take into account all the price return and all those dividends that have been paid out every single month. And again, just because we're talking about some relatively safe higher yielders, JEPI is going to offer you exposure to a lot of blue chip names, but again, with that cover call overlay, unless the market really dips, which of course it still can, JEPI is going to be somewhat of a safer option that's going to yield pretty much close to 10%. Now, speaking of JEPI, also JEPQ, one of my favorites, the JPMorgan Nasdaq Equity Premium Income ETF. This one, of course, utilizes the Nasdaq 100 as an underlying, but as it says right here, with less volatility, and that's because of the cover call overlay. Now, just like SPYI and JEPI, JEPQ offers exposure to a ton of blue chip names, which again, generally speaking, have always recovered. And again, with that cover call overlay, it's going to pick up some of the slack at least, but again, nothing is necessarily safe from an all-out crash. Now, that being said, since inception, which this ETF has not even been trading all that long, JEPQ is up around 54% in the green, which is not bad whatsoever, especially for an income-focused ETF, which has already been living through some decent volatility. Now, a few more ETFs that I think are going to do just fine, generally speaking, and still yield a lot, again, generally speaking. GPIQ, or the Goldman Sachs Nasdaq 100 Core Premium Income ETF, another ETF that offers exposure to, you guessed it, the Nasdaq 100 index while dynamically selling call options, allowing for some participation in upside, but also a lot of income generation from day one. Now, the cool thing about GPIQ is that it offers around a 10% yield more or less, but also if the market turns green and bullish, you're going to see a lot of upside exposure because of the way this ETF is built. Now, as a side note here, I've talked about all these ETFs and went into them all in detail on my channel, so subscribe and check out some other videos if you guys are interested in that kind of thing. Now, GPIQ since inception, which was back in October of 2023, a $10,000 investment would now be worth around almost $14,000. Now, since inception, that's around a 30% increase, which is not bad whatsoever, again, for an ETF that's more or less focused around premium income. Now, the last and final name that I think is going to do just fine once again during normal market volatility, especially if there isn't an all-out market crash, is GPIX, an 8% yielder, the Goldman Sachs S&P 500 Core Premium Income ETF, which as far as this one goes, you're offered S&P 500 exposure, which again, generally speaking, is probably going to be okay. Of course, unless we see a massive crash. Now, GPIX offers a little bit less income, but still in the max time frame has offered a nice amount of growth. Around $10,000 investment would have once again been almost $14,000 since inception. Now, with GPIX, we're seeing around a 26% total return since inception, which is not bad whatsoever, and is more or less keeping up with the SPY. Again, I say names like these are going to be generally safe because they're well constructed, they have good management, and the underlying exposure is the S&P 500. Once again, like I said during the intro of this video, if you're buying into Misty or TSLY or any of the names that have a single stock as the underlying exposure, those names could do very well if those underlines also do well. But when things turn red, and sometimes they do, you might be asking yourself, why didn't I just get some S&P 500 exposure as the underline? Because let's be real here, the S&P, the Nasdaq 100, those underlines have typically done pretty well. Now, I say all that to say that there's only going to be probably one safe haven if the market does absolutely crash and if everything does absolutely crumble, and that's going to be buying into the VIX somehow through an ETF or some other way. Because let's be real here, when the market absolutely crashes, not even the S&P 500 or Nasdaq 100 underlying ETF is necessarily going to save us. But that being said, most times, at least throughout history, the S&P 500 and Nasdaq have done quite well, but I guess to be fair, only time will tell. So now that we talked about 5 different ETFs that I think are going to do just fine because of the underlying being the S&P 500, the Nasdaq, or some sort of mix of the two, I lastly, most importantly, want to hear from you guys down below. When it comes to market uncertainty and maybe even possibly a market crash, and when it comes to ETFs that yield, say, 7, 8, 9, 10%, which ETF or ETFs do you think is going to hold up quite well? Let me know in the comments down below. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.